right, let's give a little update here. Multifamily mid-year market update. This is from our friends at IRR.com. Folks, if you haven't signed up with IRR.com, you got to do it. The reports that they give are absolutely fantastic. Make sure you get on their mailing list so that you will get their updates all the time. This is their mid-year market update for multifamily. Multifamily safe harbor for institutional investors had a very slow start in 2023 with investment volumes off by 50% plus in most markets. Planned projects were stalling or canceling. An investor market slammed with a bid-ask pricing gap for the first time in over a decade. That is huge, and that's what we're seeing now. And that's kind of what you just saw with Denise. There's a huge bid and ask price gap, and real operating challenges managing increased expenses and slowing rent growth. Insurance costs are on the rise. Utility costs are on the rise. CapEx is obviously because of inflation. Everything's on the rise. So that's why you're seeing this type of the investment volumes off by 50+%. The national multifamily market shows a mix of growth in key cities, but rising vacancies due to varied regional dynamics in other cities. Eastern and southern regions display contrasting performances with robust growth in northern New Jersey, Boston, and Florida, while areas like Birmingham, Alabama, and Raleigh, North Carolina are experiencing a slowdown. Despite challenges in the west and central regions, strong demand persists, highlighted by a boom in Louisville and steady demand against regulatory constraints in the West. Changes to regional investment metrics from Q2 to quarter for 2022 through 2023. The cap rates, urban properties in the South led with the highest cap rate increases nationally at 54 basis points to 5.1%, while suburban properties in the West saw the least cap rate expansion of 32 basis points to 4.82. But the common denominator is cap rates are going up everywhere. Market rents, Class A properties saw the highest regional market rent increase in the central region at 5.64% and led nationally with a 4.45 rise, while Class B properties experienced more modest growth with the lowest regional increase in the South at 1.97% and a national increase of 3.08%. Vacancy rates, Class B properties in the East exhibited the most significant vacancy rate fluctuations, with a national increase topping out at 107 basis points to 4.29%. And then market cycles from 2022 to 2023 over a 2-quarter period. The national multifamily market, including the East, South, and West regions, witnessed a marked transition from expansion to hypersupply since Q4 2022, indicating a probable cooling down on pricing and velocity in the coming 12 months. And folks, if you want to get this whole report and if you want to see which regions are in the hypersupply or in the hyper contracting phase, go to IRR.com. You can download their multifamily report. It is absolutely fantastic. David, what do you think about that information?
Well, I think one interesting thing is they didn't mention the Midwest at all and how the Midwest is performing.
Yeah, is it why? Why? Because you think it's slow and steady and they're not really an outlier?
Yeah, the Midwest is doing much better. I mean, I think the base cap rates were higher in the Midwest anyway. So, I mean, you weren't looking at, 4% cap rates, generally speaking, in most Midwest markets. But I mean, like Overland, now we've seen this year a 10% increase in rents in Overland since the beginning of the year. But that was because Overland never had the, 25% increases or whatever that places like Austin or Orlando or Phoenix had, right? I mean, it's just been steady. I mean, probably when Phoenix was doing 20%, Overland was doing 6 or 7. So it wasn't like it wasn't doing anything, but it was definitely, more slow and steady.
Yeah. What do you think about that Louisville statement?
Well, of course, we like that. I mean, I guess Frank kind of demonstrates that right now, right? I mean, he's done several deals in Louisville that have gone very well. Obviously, a little bit of a blip in the road right now, trying to sort out an issue. But generally speaking, I mean, the guy moved there because the market was so good, and I mean, everything we're seeing there indicates the same thing. I mean, I think and we have, like, I guess you never want to say it's a unicorn, but I kind of feel like we almost have that unicorn product, right? I mean, we're the bad property in a good neighborhood, so we turn around and we have nothing but upside.
Yeah. Yeah, that's the first rule I ever learned in real estate, and that I took it to heart and bought my first dog of a house and fixed it all up, made a ton of dough on it, just timed it perfectly. Yeah, I mean, everything is just, you're not going to see those big swings, but when you see like David was just saying, a 10% increase in Overland Park, Kansas. So it's like, guys, Midwest seems to work. I mean, we're seeing numbers working in those communities. Some of those other, and then Florida, I was surprised to see that Florida is still one of the strongest markets. I was expecting Florida to take a dirt bath. Why do you think that is, David?
I think you're just early. I think you just have to wait it out a little bit longer.
You think it's going to crash?
I think it's coming.
Hey guys, you got to check out, go on YouTube and check out Reventure Consulting. David always sends me this guy's videos. It's very, very interesting. Reventure Consulting. Nick, what's his name? Gurley.
GEHRLI or something like that.
Yeah, he's always got some very interesting takes. And the thing is, he's always making predictions. He's always saying that at the end of the year, he does a recap. And you can get it on YouTube. He does a recap on all of his predictions. He's straight up. He says, I was wrong on this one. I was right on this one. And that's always a good one to watch. Yeah, Reventure, that's it. Good stuff. Really good stuff. I highly recommend everybody tap into that. So now I'm going to get into my lesson part, and I'm going to just kind of run through this because we haven't gone over these things in a while, and this is going to be a nice, quick lesson. Everybody's going to learn a lot. And there's some of these things, oh man, I've been doing this for so many years that they keep coming back, and I keep having to teach it, which is totally fine because I don't want anybody to make any mistakes. All right, let's see here. Questions I always get asked. Number one, how to structure seller financing. And the thing is, the first one here is always ask in the LOI if it is what you're looking for. In other words, what I'm saying here is we had a situation just recently, again, where, we did ask in the LOI, but we tried to get seller financing after the first initial LOI had gone out. That's the toughest time to ask for it because the guy's already seen your initial offer. So if he thinks, hey, I don't have to do this deal and offer seller financing, why bother doing it? Always ask the broker ahead of time or the seller, hey, are you willing to get creative? And if they say yes, ask them to describe what they mean. Let them do the description. Don't you try to come up with your own structure. Ask them what they're willing to do, and then go back and draft the LOI so that it includes that language. You can't ask later. I mean, you can ask later in the process if it's the only way to make the deal work, but it's a lot harder at that time. I've seen it. Look, Dave Peters is a perfect example. Overland Park. It came down to virtually the closing table where he had to go back and tell the seller, hey, the only way we're going to get this deal done is if you take back some paper. And the guy had to do it. And boy, that's a great way to get seller financing because the guy had a gun to his head, thanks to David's structure. Never sign personally. Now, I know there are people that always argue with me over this one thought here, but listen, if you don't have to sign personally, don't do it. I signed personally with 4 other partners. We ended up, because of market crash, we owed that money joint and severally personally. And when they came after it, I was the only guy that had any money. And I ended up paying for it. And everybody else walked scot-free. But when we signed on the deal was going to be great. listen, always make sure the home your kids live in is safe. Don't sign personally for anything. This is a business that we're in. Always make the seller mortgage a first position lien. If the seller offers to be the bank, make sure that he's the only bank ahead of you. Make sure that if it turns out, you give him 20% down and you're really just doing a wrap mortgage, that's dangerous. Don't put yourself in that position. Make sure that you're only dealing with one bank and it's the seller. Always make the second mortgage coterminous with the first. So if you have a 7-year term on the first mortgage and the seller has offered to give you a second mortgage, make sure that second mortgage ties in term with the first. Because I'll tell you right now, if you've got a GSE, a Fannie or a Freddie deal, and it's a 7-year term, and you somehow get some form of seller financing with a 3-year balloon, at the end of that 3rd year, you better know where that money's coming from, or you're in big trouble. You can't refinance that first deal because you're going to pay huge prepayment, huge yield maintenance, huge defeasance penalties. You can't pay the guy out of that property. You have to make sure that money is coming from somewhere else. So you've got to make sure your life is so much easier if you make the second mortgage run with the first. And if the guy says, no, I want it in 3 years, can't do the deal. You're going to have to be right in line with the first bank. Any capital event has to tie in with the first lender. So make sure that any subsequent capital event, like paying off a second mortgage, ties in with the same term as the first. Let's see. Always negotiate the longest tail possible and negotiate an extension. You want to make sure that first that term for the seller financing is as long as it possibly can be, and give yourself an out. Always negotiate an extension. If seller financing is behind a bank first, make sure it's allowed, because I'll tell you folks that most banks don't want anyone behind them. Government-sponsored entities don't want anyone behind them. You might think, well, why do they care? They're in a good position. Because this is commercial. This is different than residential. In commercial, you have a personal relationship with your lender. They know who you are. They watch your reports. They want to see how your business is being run every single month. If there's a problem, they jump on it right away. They approved you for that mortgage. They didn't approve anyone else. There's only one KP on that deal, and the bank has approved that guy. They don't want anyone getting behind them who can kick you out, who can foreclose on you. They don't want anybody behind them with foreclosure rights. Okay, so that's why you always have to get permission from the bank to put any form of seller financing on there. Now, I'll tell you, the way we do that second mortgage structure is we create another class of membership within the LLC that looks, acts, and feels like a second mortgage, but it is not tied to the property. It's tied to the business. And remember, whenever you're doing a deal, the bank always wants to see your operating agreement. So they're going to see how you structured it. So they can't claim that they didn't know that that's how you set up the seller financing component. All right, number 2, tenants pay utilities. Yeah, this is a quick and easy one. I get this question a lot. Hey, it's a tenant paid utility property, but we're still seeing electricity on the P&L. Why is that? Well, the thing is that you're always going to have electricity that you pay for on the property, and one of the things that you're going to pay for are vacant units. And one of the things you want to do is when you have a vacant unit, you contact the utility company, let them know to turn that turn that unit down to the landlord rate, which is a lot less than the actual tenant rate. Water and sewer are always the always the responsibility of the landlord. That's usually a Board of Health issue. They shut the water off to a building. That's a that they'll come in and shut you down. At least your bank will. You can bill back for it, but landlord always pays for the water and sewer. Trash is usually the responsibility of the landlord. You can bill back all these things, but it's usually your responsibility. So that it'll always show up on the expense side of the P&L. If you bill back for it, then there'll be a line item category in the profit and loss in the income side. And like I said, if the tenants pay for the gas or the electric, we still call it a tenant paid property, even though the landlord still pays some of the utilities. Okay, next, here's a new way to cook the books. Oh, guys, when I saw this for the first time, I thought how incredibly criminally genius this concept was. I had never seen it before. What a great idea. Every dollar you set aside with each mortgage payment for the reserve replacement, you categorize it as income. And so you're actually double accounting for the income. The income comes in, and then you set some of it aside as replacement reserves, but you count that as income as well. Because, hey, at the end of the day, if I don't spend, I get it all back. So that's income to me. No. It does not work that way. Yeah, good income or bad income? If you watch this, the question is it good income or bad income? It's not income. If you count it as income, it will never show any corresponding expense, because the corresponding expense is a capital expenditure, which falls below the line, and the income should stay on the balance sheet. I've got this down here now. And the NOI will be inflated if you do it that way, because you'll bring it in the cash in, but you'll never spend that cash on any line item in the profit and loss. It's genius. It should appear in the balance sheet and not on your income and expense statement. Now, it should not on your net operating income statement. The expenditures for capital expenses will show up below the line, the net operating income line on your profit and loss, but it will not impact the NOI. The way this guy was accounting for his reserve replacement, it was overinflating his income. It was absolutely amazing. That reserve replacement expense income falls below the line as well. So it's never calculated in your NOI. Okay, let's see. Funds can only be used for CapEx. It's a liability until it's spent. Exactly. It shows up as a liability. Next. Okay. What do you do when 30% of the rents are collected as cash and not deposited? Now, this is kind of two questions here. The way I'm answering this question is if you're looking to buy the property, what do you do? You obviously, that's why we always ask for bank statements to confirm the deposits. You always want to get a third-party source to document the numbers, and nothing better than a bank statement. All we want the bank statement for is to show the income, what deposits are going into that property. We don't care if he uses it as an ATM machine or if he's paying for his kids' tuitions. We don't care. All we care about is documenting the income on the property. And we do that strictly by the bank statements. Now, typically, the objections that we get from that are, here we go. People say, oh, well, I own a bunch of properties and I just put all the money in one account. Yeah. Okay, so how do you file your taxes? Do you file a Schedule E? Yep, file a Schedule E. Okay, I want to see your Schedule E, because if you have your accountant file your Schedule E, he's going to know he's not going to sign off on the tax return unless he's able to verify what property received what income. So I want to see your Schedule E. And remember, folks, if you see their Schedule E, that is gold, because what person in their right mind will overinflate their income to the IRS? They'll try to show you that the NOI is, through some pro forma administrations, but they'll never do it to the IRS. So if you're getting a Schedule E, you're getting the real numbers. Next, or the K1 if it's an LLC. That's not necessarily the K1 isn't going to be as good as the Schedule 1, but at least you'll get to see some of the information in there. Now, if all else fails, you take the rent roll and hand deliver tenant estoppel letters. All it is you're asking the tenant to verify the information that's on the lease, the information that's on the rent roll. So you're going to ask them when they move in, how long is their lease term, how much do they pay, what do they pay for this, what do they pay for that, and that's how they do it. So that's, if we can't get anything like that, like for instance, 11 unit, that's a perfect size property for doing a tenant estoppel letters. You can hand them out to everybody. And you're going to pretty much get them all back, but you can find out very quickly whether there's a gap in the income of the property. All right, next, let's see here. What should the debt coverage ratio be? Boy, I get into arguments sometimes with students over the debt coverage ratio. It's a dynamic number. It's your sleep number. The higher the number, the better you're going to be at sleeping at night. Don't listen to the banks. You have to have your own. And the dynamic ability of the number is based upon the quality of the asset. If you have a high quality asset with high quality tenants, that's going to be a good property. And so therefore you can have a lower debt coverage ratio than you would if you had a Class C property where the people move out in the middle of the night and don't tell you that they moved. And you have to make sure that you've got a big spread in that debt coverage ratio to make sure that you're going to be safe to cover that mortgage payment at the end of the month. Nice properties have nice tenants who pay on time. So I look to have about a 1.3. Now, I know some of you are sitting there saying, hey, Charlie, my bank says I can have a 1.2. Yeah, sure they can, because they're in first position. They're collecting $1.20 of every dollar you make, or they collect $1 out of every $1.20 you make. You're stuck with 20 cents. So if you have a risky property where the expenses are volatile, a 1.2 does not leave you a whole lot of room. So I don't care what the banks are saying is a right number. I care what's right for me as a business. And at 1.3, because it's a nicer property, things don't break on it, we don't have much in the way of bad debt, a 1.3 is a good number for a Class A property. 1.2, you can do it, but man, it's tight. And keep in mind, there's a guru out there that teaches about the Holy Trinity. You got to have the Holy Trinity. He says you got to have 1.6 debt coverage ratio on all your properties. Okay, folks, if that is the rule that you have to live by for all your properties, you will never own a nice property, because your numbers would never pencil out to a 1.6 on a Class A, B plus B property. So don't listen to what that guy has to tell you. Understand that the debt coverage ratio is going to change based upon the quality of the asset. You can't use one standard for all properties, just like you can't use the bank standard of 1.2. All right, tough properties have tough tenants who don't pay on time, and sometimes they don't pay at all. They don't care what their credit rating is. I've never collected bad debt on a Class C property before. you can go with a 1.6 debt coverage ratio then. Banks don't care. They don't care if it's a 1.2 or 1.3 or 1.6. They just care about 1.2. And the reason why they don't care is they'll just take your collateral. They're the ones in the safe position. So that's why they don't care if it's more than 1.2. It just has to be 1.2. And by the way, I was reading I'm on the board of the National YMCA. And I was reading through their loan doc information, and their debt coverage ratio for their debt is 1.1. They're a nonprofit. They don't have to show profit. So therefore they can show a lower debt coverage ratio. The bank knows they don't have to pay any dividends to any investors.